Hi, everybody. My name is Dan Weiskopf. We're going to let some people join, and then we're going to start the show momentarily. As always, we really appreciate your engagement and questions. It always makes it more fun when people ask us questions, and then we can possibly get stumped. Nah, not at all, not at all. So we're going to be talking a lot about risk today, and we're going to have a very good show, a very interesting show. David, thanks for doing it as well. Okay, we're about stable on number of people showing up at this point. It, of course, live stream, so there are lots of folks out there too. So with that, I'm going to start up. Hi, everybody. My name is Dan Weiskopf. I'm known as the ETF professor, also member of the investment committee at Title Financial Group. I'm the lead ETF strategist for the ETF think tank and co-portfolio manager of Block, the largest blockchain ETF. I'm going to hand off the mic to my colleague, David Dziekanski. Go ahead, David.
How's it going, everyone? David Dziekanski here. Very excited to be here with Michele Wucker, founder of Rhino, focusing on all the risks we know that are in front of us, but we're unaware and don't talk about and don't plan for, which I'm very excited and I think is very prevalent in markets today. Michele, if you wouldn't mind, please introduce yourself and tell us a little bit about Rhino, how you came here, why the name Rhino. I'm so curious. Do you have like a picture of a rhino behind you to put this in context for us?
I actually do. So I'm Michele Wucker. I'm a recovering policy and finance wonk. Who I'm having a relapse, unfortunately. I'm a strategic advisor. I've been doing a lot of speaking all over the world the last several years, but I advise some companies. I talk a lot about risk. I talk a lot about some of the top trends, scenarios. I actually don't like to call them top risks, and I can tell you a little bit more why. But I have a wide-ranging background from running a think tank, from board governance, from way back, being the Latin America bureau chief of International Financing Review, and writing about a proposal to write down Argentina's debt before it got too late, that didn't get adopted. And so, we all know what happened. It defaulted, and chaos, and 16 years of legal wrangling, and investors eventually lost 70% of their money instead of the 30% they would have lost if they had followed this proposal. And if my math's right, that would have been better. So that was 2000, 2001. I did a lot of work on sovereign debt restructuring and why it made a lot more sense to just capitulate and fix things earlier, a restructured debt. 10 years later or so, I was running a think tank in New York, and we had a group called World Economic Roundtable that was a really smart group of policy people from Wall Street. And I made a proposal at that point that Greece, which was in similar situations, the economy is going down, the debt's going up, the numbers are not going your way, that Greece needed to learn from Argentina and its missed opportunity. So I published that as a white paper in spring of 2011. It was one of the first calls for a preemptive restructuring of Greek debt, and I think helped to catalyze the discussion that led to a much more orderly restructuring instead of the chaos that we saw in Argentina. And so just after Greece and its creditors reached an agreement, I was sort of thinking about my own life and what I wanted to do, and I hadn't written in a while, and was really interested in a big question, which was, how come one country saw a big scary thing coming at it and dealt with it, and the other country didn't? So big scary thing coming at you, the rhino with the horn, that's pretty obvious where it came from. And of course, being in New York at the time in the finance world, one of my friends said, ha ha ha, you could call it a black rhino, after the black swan, of course. And I've actually spoken quite a lot about how the black swan concept was misused and abused, not as intended. So I didn't want to be derivative of something that was sort of talked about popularly in a way that wasn't what the author intended. But I remembered vaguely going to the zoo when I was a kid and thought, wait a minute, there actually is something called a black rhino, right? Or was it a white rhino? Let me go to Wikipedia because I don't remember. And that's when it struck me, the black rhinos are not black. The white rhinos are not white. If you go to a zoo with a 5-year-old and ask them what color is the rhino, they will say gray. And it's the most obvious thing. And so that part of the metaphor is for how much more likely we are than we think to not pay attention to obvious things. And also how much more likely our competitors or people on the other side of the trade or policymakers or everyone is, how there are big obvious problems that if you just look and take a fresh look and really analyze how you're responding, how others are responding, there are all kinds of opportunities from market gaps to if you're a business running a business to strategy opportunities. The whole cliche of turning a crisis into an opportunity is actually very much real in the world of the gray rhino. And so in January 2013, I talked about this at the World Economic Forum annual meeting in Davos just over 11 years ago. And 2016, I came out with a book of the same title. It included a 5-stage framework, lots of examples, some of the cognitive biases that cause us to ignore gray rhinos. And I should say also that gray rhinos are not by definition ignored, even though I emphasize that in the title of the book. And the reason is that when we circulated the book to US editors, they all said, well, if something's obvious, of course we should look at it, but we are looking at it because it's obvious. So this is not counterintuitive. And I went, oh man, this is so counterintuitive. They don't even realize it's counterintuitive. Wow. So I had to emphasize for the American audience, yes, we do neglect obvious things, but the point of the gray rhino is not to normalize and justify ignoring obvious things like the elephant in the room, but it is to raise a challenge. How do you be one of the people who sees the gray rhino, recognizes its strength, and does something about it, as opposed to the people who get trampled? And ideally, you'll use the strength of that gray rhino to create something, to profit, to really use it to hopefully everyone's benefit, but certainly to yours. And I always bring up any startup going to pitch a company to a VC. The first thing a VC wants to hear is, what's the problem you're solving? And so if you look at it from that angle, the gray rhino is very much an opportunity as much as it is a danger. So that's sort of how the gray rhino came to be from my work in the policy world and in the finance world, and particularly having been a sovereign debt geek in the very early days of my career, and I've never really recovered from that.
Wow.
So can you put some context to how this might be framed in our world with everything going on with the banks and SVB and New York Community Bank and BTFP and reverse repos, and I call it the alphabet suit of Fed acronyms that just kind of seems to grow every single year. So yeah.
Yes, and you know what? I actually learned something recently about acronyms because I'm terrible with them. Apparently, it's only an acronym if it creates another word, and I forget what the word is for it if it's just a bunch of letters jumbled together. So I'll look that up and tell you what I remember. But yeah, there's so many things in the market. Silicon Valley Bank, when that blew up last year, I got so many calls and emails, come on my podcast, talk to me about this. And there were a couple of things about that situation. We're just about on the 1-year anniversary. And one is everybody knew interest rates were going up. Not a secret. Everyone had been talking about it. People had been anticipating it even before it happened. Everybody knows. I learned this in accounting and finance for international affairs in graduate school. Price goes up, yields goes down, and vice versa. And so, as interest rates are going up, the prices are going down. Well, finance 101. But apparently, a lot of people weren't paying attention or weren't buying that. And so Silicon Valley Bank, of course, had not managed that risk properly. And then one of the big things that came out was that it had not had a chief risk officer for 8 out of the 11 or 12 months before the failure. And you also look at the ratings agencies, and a few days before it got taken over, there were some adjustments downward, but it wasn't default until it had actually defaulted. And a lot of these default ratings are retroactive. So that's a very clear gap. And there's been all sorts of analyses of what went wrong and why. And of course, it had to do with the hold to maturity Treasury and other government agency bonds that they had on their books at face value instead of marked to market, which was fine until they had to sell them for a bank run. And, all those sort of things that, if I think there was a sort of a policy failure in there, and I think we haven't resolved it yet, around this hold to maturity thing and keeping things on your books at face value when they're not. It sort of delays the moment of reckoning. And I think that we're looking at that situation now with the end of the Fed facility that was put in place around the time of the bank failures to try to keep a bigger bank run from happening, but that increased bank profits without really pricing the risk properly. So that's just one of many things I've it's been written about in I have this little spreadsheet of all the times it's been mentioned. It's about 2,000 articles and counting all around the world applied to things from particularly China's financial risks, from real estate to peer-to-peer lending platforms, to over-aggressive borrowing by corporates abroad. Today, actually, there was just a new article in National Review a couple days ago, and they've been talking a lot about commercial real estate as a gray rhino, and that's going to have a lot of ripple effects. But I've seen it used in contexts from food security to climate change. I get asked about quite a bit. That's something that people are talking about. It's not a secret to anyone. People are talking about it, but only some people are doing something. And as a group, humanity is not doing enough. So it's widely applicable to these 30,000 foot issues, which is where I started, but also to sometimes mundane corporate things like, succession strategy or, basic risk management. And then my readers told me something which blew me away because I'm not a self-help writer. They said, "Oh, I applied this to my personal life." And that surprised me. So it's widely applicable, and people look at gray rhinos from very different angles. A gray rhino around commercial real estate for a regulator might be different from a regional bank, from a bigger bank, for urban planners, for say a business who's looking for property cheap, a developer who's looking to upgrade a C property to an A property. So there's a set of challenges, dangers, and opportunities, and different actions depending on the context and the angle that you're coming at it from.
So on the topic of community banks, like how do they get ahead of this? We just finished putting together some charts and saw that the commercial real estate space is about 7% of large banks' balance sheets and about 30% of small banks' balance sheets. So what arm do they need to cut off to make this better in the long run, and how do they facilitate that now? Right. Last year was a duration problem, and this year is a credit problem. Right. So
it's a very big problem. And, I have always been an advocate of early restructurings to prevent more pain further down the road. And I think that there's really a public-private cooperation that needs to happen here. And going back to my days of writing about sovereign debt, a lot of those workouts included multilateral financial institutions and bilateral other governments, as well as creditors. And for cities, I think there's a huge opportunity here and a huge danger. I mean, as these properties are being written down, cities are going to take a big hit from property taxes. And so they have a very big interest in making sure that this turns around. And I think certainly, federal financial policymakers are keeping an eye on lots and lots of cities and their potential impact on the broader economy. And so I think really a combination of quick write-downs, quick sales, ideally, new equity to upgrade some of the dingier buildings. I think also to look at multi-use situations. I know in New York City, where I lived for 23 years, a lot of those big buildings are so big. There's a lot of interior space with no windows where you can't convert it to properties, but there are all sorts of other things that it could be. And it's funny, I was reading for quite a while that there's so many challenges, it's impossible. They're not going to be able to convert these buildings. But I stumbled on this article the other day. It said between 2021 and 2024, the number of apartments scheduled for conversion from old office spaces increased like 5 times. And office conversions are now almost 40% of a lot of apartments in future adaptive reuse projects. And so I think it's happening in a lot more places than we see. And I think cities are really looking at what to do with downtowns. I mean, people don't want the long commutes, which is great for carbon emissions and things. So if you can get these multi-use situations, you're going to have to change some zoning laws. You're probably going to have to provide some tax credits, some tax breaks that are going to need to be financed. There's going to be impacts on municipal budgets because of this. And the numbers that you were giving about percentage of community bank balance sheets that involve commercial real estate, there's actually quite low compared to some of the ones that I've seen. They range all over the place, and the smaller banks are the ones that are the most vulnerable. And often it's just one or two big loans or your borrowers that are involved. So I think it's really important to look at those smaller banks. One of the concerns that came up last year around Silicon Valley Bank, when people were putting their money into bigger banks and putting their money into money market funds as yields were going up, was that a lot of the smaller regional and community banks are the ones that have much better relationships with their customers, much better relationships with the people who are the heart of the real economy. And those relationships are so important for risk management. In fact, some of the lower end of financing, you're talking about character-based credit and new credit-based scoring models. And so the smaller and regional banks play an incredibly important role in the Main Street mom and pop economy. And they've got some very, very positive externalities. So I think it's really important for policymakers at all levels to make sure that they're supporting those banks, that they are supporting smart urban redesign and conversion, and that they encourage quick restructuring so that the problem doesn't drag on and on and on and on. So it's much bigger than a finance issue. And I think it really requires help from and attention from lots of different angles.
So I was around when the Resolution Trust organization was established, right? We know we have a problem.
Old?
Thank you. We know we've got problems here, right? Should we create something like that now in anticipation of what will ultimately happen with some of these regional banks? Because the reality is, I think certain banks that stepped in recent times are too big now that they can't help out like they did recently.
Yeah. I think that the sooner that people can start working on a facility, ring fencing the bad assets, and supporting the better ones, the sooner that can happen, the better. When I talk about the progression of a gray rhino, there are 5 stages. It starts with denial. No. Usually by the time people are talking to me, they're not in that stage anymore. No. Then there's the muddling, which is everybody recognizes it, but they've got reasons why it can't be dealt with. These buildings can't be converted because there's there aren't enough windows, or they're too old, or they're too this. And to be honest, some of the buildings can't be converted. And one of the parts of gray rhino theory is that sometimes letting things be trampled is what needs to happen. And I think there need to be some hard decisions about some of the buildings that are not viable as they are, and reusing that space in a better way. The third stage is diagnosing, and that's when everybody knows there's a problem and they're switching from the obstacles to what does it take to get over the obstacles and solve the problem. And that involves a lot of prioritizing of how fast is it, how big is it, who's affected, how complex, lots and lots of analytical questions. But the heart of it is what needs to happen and who can make it happen, and how do you get to the people, the organizations who can make it happen. The fourth stage, panic, is what we're trying to avoid with this conversation. And that's when people have known it's coming for a while and they don't do anything, and they run around screaming, do something, somebody just do something. And I often use the Edvard Munch painting, The Scream, to illustrate this. I gave a talk at a bank in Norway, and they just absolutely loved it. It was a few blocks from where he had lived. And the goal is really to create a sense of urgency before panic sets in. And then the final stage is action, which doesn't just stop with doing something. A lot of people say, okay, here's what I did to solve that problem. It's solved. Okay, done. And often solution is not the right solution. I mean, it's just like with Coke. They created new Coke to solve the problem of changing tastes and Pepsi increasing its market share. And they quickly found that didn't work. They made a shift. And actually the end of the story, which you hardly ever hear, is that their market share did start going back up again because of classic Coke. And that's a great example of why action isn't enough. Make sure that you're tracking the results and adjusting if you need. And so, the panic stage and the action stage is also important, because when people are panicked, they're likely to do something, but it's often the wrong thing. And they often don't consider the unintended consequences. I mean, like this Fed facility, and like the quantitative easing that we've had in place for most of the time since the great financial crisis. The side effects of that in terms of asset bubbles and financial fragilities and all sorts of other things. So, track the results, track the unintended consequences as well. But for us, you have to plan, ring fence things, start moving on hard decisions about what needs to happen to these buildings, and start getting the wheels in place for early restructurings, because that's going to be the thing that's going to ease the pain quickest.
But I guess what I'm asking is, I agree with what you're saying, but what area of the government will lead that right now? Because it's just simply not clear. And then the panic occurs, and then everybody expects the FDIC or the Treasury or somebody to come in at that point. But shouldn't we create an entity now? Because the fact is, this issue is known. And by the way, it's as known as, well, that interest rates were going higher. I mean, hello?
Yeah. You think?
Yeah.
Yeah, I think it's, and I don't have the answer, but that's the question that needs to be asked. And I would really strongly suggest that it's a multi-agency, multi-level of government, and private sector involvement as well. That we need to start creating that right now. Well, actually, yesterday, but that's not possible. So if we can't do it yesterday, then now is the second best.
Go ahead, David. Do you have a
Yeah,
question?
it does sound like you're saying, though, that like we do have the time. It may be running out, but we have the time now to respond before the panic steps in. And I think it seems like your philosophy is really the earlier you respond, the less damage there is ultimately, right? So we have the time now, but what about with the budget deficit, right? That's the underlying issue here. You mentioned unintended consequences, and in the last Fed announcement, he somewhat indicated also a trail off of quantitative tightening at about $7.5 trillion. Some people argue Bitcoin's price rise has been flows and ETFs. Very much pinpoints with like that point in time where it was like, oh yeah, we're just going to have this thing for quite some time. So what do we do first and foremost about this budget deficit? Or is it too late, or are we just headed for that pain trade?
Good question. I mean, we've seen a U.S. debt downgrade last August, which actually the Wall Street Journal called a classic situation of a gray rhino, that we all know we have this problem, we're not dealing with it. We've seen another warning on U.S. debt, which is both the financial issues, but also the political issues. I mean, you look at these charts. There was a meme that was going around, or actually a graphic that Visual Capitalist did on the likelihood of sovereign default. It was going all over the place, or political risk, I forget what it was called. And they had the United States at 0.0. And look at all the top risks this year, and like political risk is kind of really like, this is the biggest political risk there is. But one of the things that the ratings agency Moody's cited was this political impasse. Like, if the United States defaults, and we came within a few days of doing it last June, it's going to be because some people decided that that's what was going to happen. That's a huge political risk. So I think the big framework behind all of this is getting Washington to work again, getting serious collaboration, getting bipartisan deals, getting lawmakers to do what everybody knows needs to be done, that we need to get the budget in order, that during a crisis like the pandemic, okay, you can tolerate a certain amount of looseness in spending, but that you need to move on. And I think that is going to need really some consideration on all political angles. I mean, you look at at the tax breaks, the tax cuts that were made in 2017, but a lot of which we couldn't afford, and that's coming back to roost. You look at some of the spending, and I hear stories about sloppiness in how some of the climate funds are being spent, or other things. So I think I think way back to the I forget what they called it, this like improving government that this sort of Clinton Gore talked about, that actually going through and almost taking like a consulting approach to it and fixing I mean, now it's like the places that are still using paper to process things, the unnecessary regulations, and really clean it up, make it work better. You look at technology, obsolete technologies being bought by all sorts of different agencies without any sort of sense to the economies of scale that the bigger purchases could be. So I think it's a combination of spending cuts and tax increases. I do think on taxes that lower corporate taxes make sense. Higher taxes on the super wealthy. You look back at where they've been historically, and they're like nothing compared to that. And I'm not saying we go all the way up to the top, but there's a lot of wiggle room till you get to the Goldilocks point.
There are a lot of people who have been talking about the fact that if you just think about it, like forget about like incremental changes, and you're just like, this is how much we tax people to make money. And then once they've made money, like you can grow it and just pay like a very little bit of tax. And so it just makes it that churn of like going up that socioeconomic ladder that much harder, and gets you that much more embedded up there once you reach that level.
Yeah, and I think a lot about the economy as sort of an engine. Like if you don't put enough oil in, it's bad things are going to happen. I used to work on cars when I was in college, so I could see how that works. But I think if you don't have enough oil, sort of lubricating the lower parts of the socioeconomic spectrum, that's where the spending is going to cut back the most, because there's no discretionary income to spare. I think that's really important. And I think even at the middle and even into the upper middle classes, where there's much less excess discretionary income. And what happens with the super rich is, they'll put that, when it looks like the markets are going up and up and up, they just put that money into, paper profits, instead of necessarily into the real economy. And you'll hear about, the wealth effect, the bigger people's, brokerage balances are and their 401k accounts, the more likely they are to invest. But it seems like a very inefficient way of getting people to invest. And I think that there's another big thing that's not getting talked about enough around all of this money that's going into AI. And, it's funny, I see all of these, sites and services saying, now with AI, it's like you go in the grocery store and you see, oh, plant-based. I'm like, I didn't even realize that wasn't plant-based before. And I've seen a lot of comparisons of the AI boom to the .com boom, people throwing money all over the place, often without really thinking about how it's being used most productively. And a lot of that, like the .com boom, is going to go poof. It's not going to end well. And I think that what we really need is some policy changes, and we also need some business strategy changes to really look at the human capital aspect of AI, and also to look at the fact that, a lot of these places require huge amounts of capital and very little labor. And so all the returns end up going just to the capital. And if not enough of that is going to the labor part of the economy, the whole engine is going to seize up. So it's not good for anybody, not the people at the top and not for the people at the bottom. And I think the goal should be really, how do you keep the economic engine going as strongly as possible? And how do you use every policy tool possible to do that, whether it's monetary policy, whether it's fiscal policy, and particularly tax policy, and really look at it through an entire different lens, and blank slate, even going, our system is not working the way it is. Let's fix it.
So Michele, I agree with what you're saying, but it's hard, right? Because where are the incentives to inspire, we'll say, government? Won't talk about Democrats versus Republicans, because everybody's bad as far as I'm concerned, right?
I'm with you.
Everybody has their own.
Throw the bums out party.
Yeah. So should we start with term limits? What action plan? Because listen, we know we can't continue to spend like we are, and if people are going to get taxed, they're going to want to know what the benefits are to the higher taxes.
Yeah, absolutely. I think that there are a number of areas where you could get strange bedfellows together. I mean, you look at, say, subsidies, subsidies of fossil fuel, where taxpayers are paying twice. First, the subsidies, and then paying the cleanup of it. Yeah. So I think, that's one area we could, I think, get some agreement on both sides. You get the climate people and you get the subsidies people together. I think we need to also look at the fact that we don't have the free markets that everybody thinks that we do. There's this, tax breaks and benefits and subsidies and all sorts of distortions throughout the system that encourage all sorts of distortions. And we could talk for hours and hours about that, with which we don't have time right now. I think we also think about the basics of tax policy, apart from obviously raising enough money to keep the government going, is, if you want more of something, you either don't tax it, or if the market is not meeting that need, then you subsidize that until such time as the subsidy can be taken away as soon as possible. And if you don't want something, then you tax it. I mean, it's pretty simple, but you look at our economy and that's not what is happening. I think we're not looking at negative or positive externalities. I mean, like, the fossil fuel, clear negative externalities, not good, not accurate risk pricing, similar to a lot of, market bubbles, similar to, some of these, the Fed facility for regional banks, for all banks that we've been looking at, which has been subsidizing them massively, and the money's just going to the shareholders instead of back to the taxpayers who are paying for things. So I think you look at a risk lens, you take a risk lens to tax policy, to everything, and say, what's increasing the risks and what is lowering the risks? And these, asset bubbles are increasing the risks. And then you look at, okay, what's creating that? You look at capital gains taxes are way lower than corporate taxes, taxes on the real economy, which makes no sense, because if the real economy is not working properly, then at some point asset prices are not going to be able to stay where they are. So I think that's one very, very clear area. And for people who have their money in IRAs and 401ks and things like that, the argument doesn't stand that they're going to be hurt because it's a tax-free account anyway. So I think we need to look at the role of tax policy in feeding asset bubbles. I think we need to look at, say, margin borrowing, which obviously increases profits by quite a bit, but that also increases financial instability. So I think that there are lots of tweaks that could be made all over the place. And when you're talking about capital gains in secondary markets, it's not like you're getting new money to companies. It's just paper profits. And so you could have different policies towards capital gains for businesses, for the founders, for the original investors, for the people who are really building them and supporting the real economy, and make that separate from the secondary investors, the market investors only. So those are just a couple of ideas. That's just the very beginning. But I think we need a super wonky approach to every single aspect of tax policy, of subsidies, of really how economic policy works.
You could argue those paper gains are actually destructive in value to the shareholder, right? Because they just create more warrants of shares to the operators and dilute the actual earnings if it's not actually creating any real wealth. There's some things that have been put on the table as of late, as in terms of, one is an act to have all entities and hedge funds unwind ownership of single family homes over the next 10 years. There's also been discussions of universal basic income. There's discussions of literally granting shares at the S&P 500 to members of the economy, maybe some sort of lockup, and forcing them to participate in equity appreciation. So what are the solutions that you see here?
Well, I've done a lot of work in the sort of the development finance world, and there's a lot of talk about blended finance, where you've got organizations that can borrow cheaper, being part of financing packages, particularly for things with social benefit, around the Sustainable Development Goals and things like that. I think that's quite a good policy. I've always found it to be fascinating. Well, not always, but since sovereign wealth funds became a thing, it's fascinating to me that the United States doesn't really have one, and that a lot of these sovereign wealth funds actually have their money in the United States. And so, we do have things. We have the Small Business Administration. We have all the programs that were set up during the pandemic to support small, medium, and large businesses. And I think we could look back at, some of those worked really well, some of them didn't. There was a lot of fraud. I think we obviously need to find a way to track down the people who were not using it as intended. But I think that really looking at a sort of to each according to their need and from each according to their ability approach. I've written about a group called Boston Impact Initiative that is very interested in businesses that build up communities, create jobs, and they've got a fascinating model whereby deep-pocketed philanthropists actually get a lower interest rate for their investments in these companies than the smaller, less deep-pocketed investors. And on the flip side, the smallest, most vulnerable companies pay less. And then as the companies get bigger and stronger, they actually pay a little bit more, which is sort of the reverse of what you might think of when you're talking about risk pricing for these businesses. And that's because I think it's important to take into account the positive externalities of small businesses. And then when you look at the giant businesses, well, under traditional risk pricing, they pay less to borrow. But you look at the systemic risk that they present, you look at the too big to fail aspect, and that's not priced in properly. So I think we need blended finance to support positive externalities, which actually comes back to the whole to the whole economy, and looking really at negative externalities in the whole.
I know I'm not supposed to deviate from an organized discussion like what we're having, but let me just ask you a question, because one of the things that I'm tasked with rather, is to lead a think tank, right? What should people expect from a think tank in your mind? Is it always an actionable plan is expected out of a think tank? Or do people look for a think tank to organize and inspire others? What are your thoughts around just generally what a think tank should be doing?
Oh my goodness, you have opened Pandora's box. I get so many questions from students. I mentor students from Rice University or Columbia or other places, and then I'm doing some teaching, and students are always asking about think tanks, and I look back and having run a think tank and having had a senior position at another one, I look back to school and I think I'm not even sure when I first knew what a think tank was. I mean, I'm not even sure I knew what it was in graduate school when I was in a policy graduate school, and a lot of students have sort of, starry-eyed views. It's sort of like the way I thought of the UN before I spent a lot of time there, and realized that my starry-eyed vision was not quite so accurate. And they're like, oh, you think, it's about ideas and promoting ideas. And I think that there are a lot of people who do produce some good ideas there. But in many cases, the most innovative ideas are often seen as being a little too out there. I think it's very few think tanks that actually do that sort of innovative, creative thinking. And funders, with individuals or foundations, will always ask, what's your theory of change, and how are you going to quantify your impact? And often that's really, really hard to do, and it's more qualitative impact, and it's not great for for funders to look at. But I think it's coming up with ideas and researching the sort of information that supports certain ideas or not, helping to compile information in a way that it makes it accessible to other people. And in my role at think tanks, I've been very keen about mentoring and supporting younger thinkers who are going interesting places and saying new things, and bringing fresh ideas to the world, and trying to help give them some of the thoughts and skills and connections that I didn't have when I was in my 20s, but already doing work that was influencing high level discussions. So I think it is the best think tanks have ideas. They do the research to support those ideas. They bring together different stakeholders behind those ideas for productive, constructive conversations. They bring together people from lots of different views. A lot of US think tanks tend to be tied to one political party or another, or a certain ideology. And I think that the most productive conversations are among people who have very different views, but know how to talk about them in a way that actually leads to something fresh and new, instead of killing each other when they're in the same room because they have such different opinions.
I love that. Yeah. I mean, my personal mission in the ETF think tank, of course, is we've got a little bit of an oligopoly in the ETF world, where there's some major firms who are wonderful firms, frankly, and they support us. But they're so big that when they look at an innovative idea, it has to be a 5, 10, $20 billion big idea, right? And at the end of the day, this squashes some of the smaller firms and the opportunity that they're trying to drive, right? Because people need to invest in innovative ideas to get outsized returns, in our judgment, at least. And people, I find, often view what we do more like salespeople, but that's not what we're doing. We're trying to inspire financial advisors to look beyond just the traditional investment strategies. I don't know if that sounded too much like an advertisement. I apologize if it did.
Not at all. I hear you. And this, this small versus big idea thing, I think particularly, in the foundation world, others, we want 100 million idea. And I think that often you don't know what the 100 million idea is until you give a lot of small ideas a chance. For example, I've been doing some work in the food sector right now. As anyone who's had the misfortune of dining with me knows, I have celiac disease, which involves the celiac manifesto that I carry around the world, and the celiac inquisition that I put the poor waiters through, and try to be as minimally obnoxious as possible. But as I've been looking at, restaurants, consumer packaged goods, and, different parts of the food value chain, I've been finding that a lot of the innovations come from the smaller places. And like the big places wait until they get bigger. They want proof of concept before that happens. And I think it's actually contrary to the very idea of innovation, of thinking that the top down analysis, that the big money that's sort of entrenched in their ways, they've had their own experiences, you can't expect them to see the things that the people are on the ground and actually having the new innovative ideas are doing. And I think also the getting to those big ideas involves a lot of failure, and throwing a lot of spaghetti at the wall and seeing what sticks. And so it involves a certain tolerance for failure, which you see in publishing, you see in venture capital, you see in angel investings, all these places. People will they know that not every single one of their investments is going to be big, but they assume that the really big ones are going to be big enough that it covers the cost of the small ones. And it's like Thomas Edison says, isn't it? I didn't do things wrong 100 ways. I just found 1,000 ways that didn't work before I got to the right one. And I think that's so important to the innovation process.
One of my pet peeves, this is a little off subject, so forgive me.
Forgiveness needed.
Yeah. So there are so many companies that are aggressive about their buyback programs, right? And I'm not looking for you to comment on any particular companies, but when I look at a company that's spent 10, 20, $30 billion, 40, $50 billion on their stock, I think, wow, wouldn't it be just wonderful if they just spent 5 of that billion and solved some of our real problems? That's out of the box thinking when it comes to think tanks, I think.
When I see those stock buybacks, for me, it's an indicator of perceptions of the strength or weakness in the economy. And it goes back to what I was talking about, this financialization, the financial versus the real economy. It's like, if a company feels like they and their investors are going to get a bigger return by, buying back shares and, driving up the price in this house of cards, and they don't feel that the real economy is worth investing in, that says to me that the house of cards is not going to stay up for very long, because the more you take away from reinvesting in the company, or in other companies, whatever you're doing, the more you're doing that for often for short-term gains and for these paper profits, you are actually destroying long-term value in the company.
Mm-hmm.
I'm sure you've seen all these estimates. I'm sure some of them I mentioned in the Gray Rhino, about how huge percentages of big companies' value are the result of long-term investment and long-term views towards the future. Some of those bear themselves out, others don't. But I do think that this pulling capital out of the company for short-term gains is not super supportive of long-term value. And so, if I see a company with lots of buybacks, I question, okay, what does the board, what does the CEO see as the future of this company? And to me, it's a it's a negative indicator of the company's future health. And there's not saying there are times when the buyback is the thing to do, when the market's at the bottom, when, all sorts of other situations. But when the market is as high as it is right now, or in other cases, companies that have taken lots and lots of PPP money, taxpayers' money, and are returning it to the shareholders. I mean, to me, that's wrong as a taxpayer. And, I think taxpayers of every party can agree on something like this. And so you can't be pro lower taxes and pro buy things back with government money and, be a fiscal conservative. I mean, that just doesn't, I'm sorry, this does not wash.
Yeah. So in 2024, given your background, what are the risks that keep you up at night?
And so this is where I get to, I said before, I was going to challenge a little bit this use of the word risk. And I think we need lots of different words for risk apart from the ones that we're using now. Because every year we get all these top risks lists. And I have the spreadsheet. I've got, dozens and dozens and probably hundreds of them. And everybody puts those lists out at the beginning of the year because they're great marketing tools. And I always get asked by clients, and I finally just gave in. They're like, what are the top gray rhinos of 2024? So I finally said, all right, I'm going to talk about it. But it's so there's risk. The classical economic definition is a probability that you can quantify, as opposed to uncertainty, which you cannot quantify. And I think that a lot of this quantification is like in The Princess Bride, there's a thing where Visick says, you use that word a lot. I do not think it means what you think it means. And, you look at the investment grade ratings on the subprime bonds or other things that supposedly are solid numbers that are not nearly as solid as they think. And so these top risks lists are, they're also about passive risks. They're like, these are the things that might happen in the world. And it might affect your company in this way, that way, or the other way. But for me, risk is choice. It's taking a choice. It's looking at the options in front of you and choosing the one that has the best likelihood of succeeding as large, as impactfully as you can. And so risk is never one thing. It's an array of things. So with that said, the top gray rhinos are things coming at us as opposed to risks. The last several years, I've been very concerned about a couple things. These financial fragilities. Just looking at monetary cycles and debt and asset bubbles. I can't help it. Climate change. We're in Chicago this summer. We were #1 among the big cities with the worst air quality. Not exactly a #1 you want to crow about. And looking at all the weird weather we've had and all of the potential impacts of that, and it ties back into financial fragilities because insurance companies for quite some time have been worried that they are sufficiently capitalized against extreme weather. And we've seen in Florida, California, other places, they're pulling out and going, ain't going to do it. And that's going to have long-term impacts on real estate, on cities, on all sorts of things. So looking at that interaction between those two. Geopolitics is very high on my list this year. I've been so concerned looking at the US-China relations. As you probably know, the gray rhino is very, very big in China. And so I've made quite a few trips to China since it came out in 2017. And I look at some of the narratives that it's almost like a script that a lot of people repeat. I think US-China relations are so important to global security, to climate change cooperation, to global economic stability. I'm glad that it looks like we've seen some steps towards calming things down over the last couple months, but I'm worried about how long that's going to last. I look at the Russia-Europe situation. I look at the situation in the Middle East. It seems like there are more conflicts right now than any time in recent memory. well, forget, previous generations who I think would probably have something to say about that. And those affect supply chains, financial markets, energy prices, commodities, food prices. We've seen there were a lot of warnings of possible hunger because of the Russia-Ukraine war. So that's very big on my mind. And then I would be remiss if I didn't mention the whole AI situation, because it seems like everyone's talking about that. I am not one of the ones who says that the robots are going to rise up and kill us all. Like, that's not the thing. I think it's the misallocation of capital, privacy concerns, misinfodemics. I think it's becoming harder and harder to see what's real or not. The flip side is I think there's a lot more value on truth and real things, and the question is just how we're going to do that. And I think there might be some solutions using blockchain and other ways. But I also worry about the skills side of it, but also the skills possibilities. I think that one of the great things about AI is it's going to be able to make people with less education able to do things that they weren't before, and that has such huge potential for good. But there's going to be a lot of disruption, a lot of change, a lot more uncertainty than we're used to. And that always leads to, unexpected problems. But those are the things on my mind. And, we've talked about a bunch of the financial fragilities that are top of mind right now. On the real estate situation, I see the Western media for quite some time has been talking about China's real estate situation. And the narrative has been, oh, they screwed it up. Well, look what a mess they're in. And I think it's basically a preview. It's a preview for what some of the things that we might be dealing with as well. And, some of the underlying problems are different in the Chinese economy versus our economy. But I feel like in the United States, we have not been paying nearly enough attention to financial or climate or political or other gray rhinos. So lots on my mind.
Wow. Well, I asked you the question, what keeps you up at night? And
I never sleep.
you don't sleep. Yeah.
That's not true.
Michele, thank you very much for joining us here and letting us know about the Rhino.
Thank
Very
you so much.
interesting.
And sleep hygiene, digital hygiene for sleeping. There's actually an 8th grader in Bangalore who talked about digital addiction, and she talked about that as a gray rhino. She got a minister in India to work with her. She was invited to the United Nations to talk about digital addiction. So I do sleep at night because I have good digital hygiene. But it's been really a pleasure to talk with you guys.
Yes, thank you so much.
Thank you. Be well.
You too.
Okay. Bye-bye.